Hello, today I'm here with Mike O'Brien, Vice President and Director of TD Asset Management and Portfolio Manager of the TD Canadian Equity and TD Canadian Blue Chip Equity Funds. And we're talking about volatility and how all the increase we've seen since the beginning of the year and all the volatility affects the way we invest. Now, Mike, good to have you. I wanted to start off with your portfolio manager, of course, of these funds. What do you do when you see all these wide swings happening in the markets?
Well, you just stay calm, carry on. This is kind of the norm. This is, or what should be the norm.
What seems to be the norm now, anyway. I mean,
well, when you think about it, actually, we've been spoiled the last year or two. If you really want to go back and be a market historian, and some people have actually done this, if you go back, 60, 70, 80 years, in a typical year, you'll usually have at least 3 occasions during the year where markets will check back by at least 5%. When you think about it today, the last time that actually happened was back in June, so June of 2013. And that was the only one we got all year. So really, we were overdue for that.
So it's been a little bit better lately. How long does it take for you to get used to the markets and all the volatility? Did it take you a few years when you first started?
Oh yeah. Well, it's funny. One of the pretexts or one of the causes, I guess, of this latest little pothole that we've hit is concern about emerging markets and currencies. Actually, I began my career at TD Asset Management in the summer of 1997, and one of the very first things I ever remember was Asian crisis. And I can still remember, at that point it wasn't called the Asian crisis. I can remember one of our analysts standing up in front of the group and explaining that the Thai baht had just been devalued, and then they went on to explain how Thailand was like 1/10 of 1% of global GDP, and it wasn't going to matter, and it wasn't a big deal. And then we spent the next 3 years digging out of that one. But so, which is to say that ever after that, I've always been very careful about when somebody says this doesn't matter or this is insignificant. But when you sort of wrap that around the current situation, I think today is definitely not 1997. So I'm sleeping a little easier than I would have been.
How is it different?
Well, when you go back to 97, you think about what this was. It was really a run against emerging market currency pegs. It was probably 2/3 of emerging market countries had currency pegs at that point. And a lot of them had accumulated significant amounts of foreign currency debt, or debt that was denominated in currencies other than their own, so they couldn't print their way out of it. And the currency pegs and the foreign denominated debt is just a toxic combination. So that's very, very different than what we see today. Today Argentina was one of the frontliners in the current bump in the road. But Argentina is really the exception more than the rule today. Most of the countries around the world have long since abandoned these currency peg regimes. The floating currency provides a bit of an automatic stabilizer for a lot of these countries. And on top of that, they've accumulated some enormous foreign currency reserves to help defend their economies at times when they need it. I think somebody had tallied up there's $7.7 trillion worth of foreign currency reserves in the emerging markets today.
That's
so a very, very different situation.
So you said it's steady as you go. Would you say it's exactly the same, in this type of volatility or in volatility than it is when it isn't, or do you do anything different?
Well, I think the first thing you want to do is you don't want to take things for granted. Like I say, for the guy that walked in the door and right. saw the beginnings of the Asian crisis, you always want to be on guard. Is there something you're missing? Is there something you haven't considered? Because if your fundamental investment positioning or your investment stance, if something fundamental changes, you have to change with it. And so that's the first thing you do is you evaluate and say, okay, is this really going to be something that's going to turn my view of the world on its head? If it is, then you make your changes, you make your adjustments. Again, I don't think that's the situation we're in at all today. So if that's the default, then really the second step is to say, okay, I came into this year with a strategy, a plan, a view of where I thought the markets were headed. So what you really do is you just try to take advantage of it and use situations where maybe there's some stocks or sectors that you really like, which in this bout of volatility, they might have taken a little bit of a hit, and you look to buy more of them. The mistake you make is when you start questioning yourself and you run away from this and you sort of pull the ripcord and get out of the way and start selling these things into a scared market. So that's what you really want to do, is look at it more as a buying opportunity. Once you've convinced yourself that, yes, I understand what's happening, I'm comfortable with the risks, I understand the situation, and then let's start moving forward.
So you've brought me some names that, now have you actually added to, the first one was Bank of Nova Scotia, have you actually added to this name?
Yes, we've been picking away. Depends how quickly I get out of the studio. Maybe we'll do a little bit more. You never know.
Some more.
Yes. So, well, I thought that was a perfect example. Just you know, we prefaced the beginning of the conversation with comments about concerns over emerging markets. You know, one of the knee-jerk reactions, you know, portfolio managers are as guilty as anybody else, is when you start reading front-page headlines about emerging markets, this, emerging markets, that. You pull out your list of stocks and which companies have exposure to whatever the cause of the day is. And so Bank of Nova Scotia is viewed as the most international of the Canadian banks. They're viewed as the one with the most exposure to Latin America and Asia. Now, if you were to take 10 portfolio managers and put them in a room, 10 Canadian portfolio managers, and you say, for the next 5 years, you can only own one Canadian bank, which one would it be? You know, my bet would be that 8 of the 10 would say Bank of Nova Scotia. The 9th would probably just be difficult. He'd be a contrarian, pick somebody else. And the 10th probably wasn't listening to the question. Okay. But, you know, 8 of the 10 would pick Bank of Nova Scotia. And yet this year, because of the headline news, it's down more than any other bank. It's down 7%. Trading well below where you would expect it to be. So in our eyes, this is the opportunity to buy a name like that.
So even with a new CEO coming in, it's still a good opportunity?
Well, I think the Street's very comfortable with Brian Porter. He's been a presence for a long, long time within Scotiabank. He's been one of their key players for a long time. The succession was very well telegraphed. And Scotia is also a little bit different than a lot of the other banks, and it's a much more collegial, might be the right way to put it, or you know, almost more of a team at the executive level, at the high level. And so I think investors, by and large, have very little concern about the transition.
And the next one you brought was Dollarama, and a lot of people seem to like that stock. Where do you see that? Yeah,
well, I agree with them. I think it's I think Dollarama, plain and simple, it's the best retail growth story in Canada today. You know, full stop, period. Best retail growth story in Canada today. Now, the thing that may not have escaped your attention is it's been bloody cold out. Yes. And I think you can remember back in December, we had the ice storm. I don't know if you lost power. Ours was out for a little while. Well, 80 or 90 of Dollarama stores were shut down. A number of others were impacted. And then, you know, and the cold weather's continued on, so they've pre-announced that their same-store sales for this period is going to be disappointing. The stock's pulled back. But when I look at that, you know, weather's a temporary thing. You know, this isn't a fundamental underpinning of the business model that's been undermined. This is a temporary thing. So I think the way I look at it is, unless you think we're going to be sitting here in late May wearing parkas, this is this is something that's a transitory thing. So you see a stock like that pull back, valuation looks a little more interesting. You know, you use it as a buying opportunity, not as an occasion to turn away from it.
Right. Well, thank you, Mike. Great to talk to you.
Absolutely.
I've been joined by Mike O'Brien, who is Vice President and Director at TD Asset Management. I'm Marianne Devenney. Thanks for watching.